Have you been looking at that one house that looks like your dream home but seems so unaffordable? Thousands of other U.S. citizens have found themselves in the same situation as you for the past 3 years due to the exorbitant increase in housing prices following the global pandemic. Before May 2020, a home buyer would pay around $2,000 per month for an average house, but today they have to pay almost 2 to 3 times that amount for the same home. You do not need comprehensive data charts to conclude that the market is deteriorating, with prices skyrocketing week by week. As the widespread belief in continuous real estate price growth takes hold, the market becomes detached from its fundamentals. The divergence leads to an overvaluation of assets, creating a potential discrepancy between market prices and their intrinsic values. It's what most experts refer to as a housing bubble. During this period, the heightened expectations of significant increases in home prices continue to drive higher prices. Thus, the bubble keeps getting bigger and bigger. Now, the question on everyone's mind is, when will it finally burst and the prices return in their favor? In this video, we will outline when it is going to happen and what to expect when it occurs, so stick around until the end. Please support our channel with a thumbs up and don't forget to subscribe to our channel. In its 2022 report, the Federal Reserve Bank of Dallas identified signs of a brewing bubble in the housing market. While a housing bubble contributes to the high property cost, it is not the sole determining factor. Other factors, such as changes in disposable incomes, credit costs, supply disruptions, and increasing construction material expenses, also contribute to the overall impact. The deputy chief economist at Freddie Mac, Len Kifer, explains why housing prices reached a record high in 2021. He said that the reasons were not solely limited to speculation and credit expansions, but also included low mortgage rates and a fundamental shift in housing demands. Market changes can be fluid, and the dynamics can fluctuate rapidly. But despite the uncertainty, market experts have still not predicted a market crash in the near future. One thing is for sure, when the bubble pops, we can expect the prices to return to the long-term average, which could be a game changer. Drawing from recent data and expert opinions, let's dive into the lifeblood of the real estate market: inventory. An inventory or supply is undoubtedly one of the most critical data points in the real estate market. Currently, the inventory is in a state of fluctuation. Let's look at the statistics from Altos. As per the report, we likely entered 2023 with the lowest inventory week of the year. If you take a step back and analyze the whole picture, you will see that there were at least 782,000 houses in the U.S. housing market before the pandemic began in 2020. Fast forward to 2023 when we started with 490,000 homes. That's around 39% fewer than the pre-pandemic world. The number is still 67% higher than at the start of 2022, indicating a slow but steady recovery. As we have seen in the past, the real estate market is resilient, adapting, and evolving. Inventory levels are expected to rise as new listings start hitting the market after the holidays. But let's not mince words. The supply is still going to be quite limited. The situation is not as dire as it seems. There's something fascinating about it. You're probably familiar with the typical supply rule. The lower the supply, the higher the expected price. But that is not happening. And this is due to the decrease in demand caused by affordability issues. Mortgage rates have doubled since last year, putting a strain on the purchasing power of the average buyer. This has led to a significant increase in the housing payment for the average home buyer. According to Goldman Sachs, housing affordability will continue to be a challenge for the remainder of the year. So how does it affect the current market? The current dynamics of the housing market are being shaped by two powerful forces: inventory and affordability. The limited inventory is causing prices to rise. On the contrary, affordability issues are causing people to strive to lower costs. The impact of rising mortgage prices is like the sudden eruption of a volcano that had been dormant for years. The Federal Reserve's decision to increase rates in January 2022 has had a significant impact. That was when the serene landscape of a 3% mortgage rate was disrupted by strong winds of 7%, which exceeded everyone's expectations in terms of speed. This seismic shift has caused monthly payments to skyrocket, putting a strain on both home buyers and sellers. Given the high mortgage rates and scarce inventory, investment banks have revised their home pricing mortgage rates with a 2.2% decline in this year from its previous forecast of 6.1% drop in prices. The once hot market is finally cooling down. After a prolonged period, the housing prices may undergo a decline, but let's not forget that these rates are still double what we were seeing only a few years ago, so the challenge of getting an affordable mortgage will remain. Higher borrowing costs have made existing homeowners reluctant to sell the houses they financed when interest rates were lower. This has resulted in a limited supply of homes for sale on the market. The country's housing supply remains limited and will likely continue to be limited in the future. Many homeowners are choosing to stay put, partly due to those who purchased their homes in recent years at record low prices. This, in turn, adds strain to the inventory. The inventory situation, compounded with other factors such as inflated mortgage rates and low buying demand, is creating a complex and challenging landscape. The affordability of homes, which was already a challenge, has become an even more significant hurdle. The combination of these elements is setting the stage for a market meltdown, which is becoming increasingly evident in the current state of the housing market. It is not just a slight downturn. Rather, the market is facing a significant decline. This decline can be attributed to multiple factors, including the soaring prices of houses. However, what exacerbates this situation is the combination of these high prices with the freezing impact of rising mortgage rates and growing concerns regarding affordability. The current market is in turmoil. As we navigate the turbulent waters of the housing market, we find ourselves in a state of uncertainty. So what does the picture look like as we head toward the end of the year? The market is crashing, turning the process of buying a home into a potential nightmare for all. The once sizzling market is now freezing, and the chill is deepening. Industry experts have varying forecasts and speculations. Some predict that mortgage rates will continue to climb, whereas others foresee a gradual deceleration of inflation and stabilized mortgage rates. If you look at it realistically, the turbulent winds still surround the buyers and sellers. The soaring prices have caused banks to incur losses on mortgages, with persistently limited inventory, increased volatility, intense competition, and no anticipated significant price reductions in the near future. The dream of homeownership might seem like a mirage to many, as the situation does not look very promising. So what should you expect? We've been hearing for quite some time that the U.S. economy is slowing down. There is a 68.2% chance of impending economic turmoil. The impending recession is much more severe than the one we experienced in 2008. It's a no-brainer that the inventory must increase significantly for the prices to decrease. The supply has to rise as high as 800,000 homes for sale, which would be about equal to the pre-pandemic era. But the bitter pill to swallow is that a crash in home prices cannot occur without risking the job market. We would like to see the rates drop lower than usual and for unemployment to decrease. The market experts unanimously agree that the Federal Reserve System will pause rates for the rest of the year. As we know, this is a sensitive time. One wrong move can cause the market to plummet and inflation will surge. If the economy takes a turn in the fourth quarter of this year, mortgage rates will rise above 7% this time. Now, if the economic turmoil worsens and the job market continues to collapse, there will be a further decline in demand. For the inventory to increase, the supply must come from individuals currently holding on to their properties. Forbes Advisor points out that many homeowners who purchased their houses in the past 2 years are currently benefiting from ultra-low mortgage rates. According to the most cited data, 80% of existing mortgages have a rate below 5%. It means that the investors are not planning to sell their properties in the near future. When this capitulation phase peaks, that is when the crash starts heating up and the true panic for the sellers kicks in. With no demands, offers will dry up and the fall will become inevitable. Once the bottom is reached, it'll mark the beginning of a long-awaited cycle reversal. A 15 to 20% decline in rates enables an open buying experience and reduces competition. However, the likelihood of a crash that could return us to the housing market conditions of the pre-pandemic world is very slim. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.